Vanessa's first year trading, like many new traders, didn't go so good. By year end, she'd accumulated a net loss of $66,000. Then she received her 1099-B and was shocked to discover her broker reported a taxable gain of over $166,000 because of wash sale adjustments. Now, despite losing money, Vanessa had to pay taxes on money she never made. What happened? Hello, I'm Jason from TradeLog. Welcome to the third video of our series, helping traders like you understand wash sales. We've learned what a wash sale is and the basics of the IRS wash sale rule. Now, let's talk about how wash sales can affect you as an active trader, particularly at tax time. I'll explain two situations you need to be concerned about. But first, let me tell you how to avoid wash sales. Before I do, don't forget to subscribe to our channel so you don't miss any future videos. How do I avoid wash sales? That's a question I hear often from traders, and there are two possible solutions. First, elect Section 475F trader tax status with the IRS. You'll then use the mark-to-market accounting method for your trading, and the wash sale rule no longer applies. However, you must qualify to make that election, and there are other tax consequences. So this may not be an option for every trader. By the way, you can learn more about trader tax status on our website at tradelog.com. Click on the Education section. The second way to avoid wash sales: never have a loss. Now, I know that's wishful thinking. However, the fact is, the more profitable you are, the less wash sales you'll have. And when they do occur, those wash sales will tend to get absorbed into your gains without negative impacts. Consider this example from our previous video. You had a wash sale which deferred the $1,000 loss on Tesla that occurred on November 21st, adjusting the cost basis of the shares purchased for $23,000 on November 24th. If you sell those shares, now valued at $24,000, for, let's say, $24,500, we now have a resulting gain, so any other purchases of Tesla within the wash sale window should not trigger another wash sale. There are no long-term consequences. True, there was a wash sale that occurred. You have to identify and adjust for it in tax reporting, but the loss is realized in the year. And what's more important, we made profit. Now, this doesn't mean you can throw caution to the wind and not care about wash sales. I often compare wash sales to icebergs. You may be cruising through the tax year thinking you know your gain or loss situation, but wash sales may be accumulating out of sight. Most traders don't find out about those massive wash sale deferrals until after the tax year is over, when they receive their broker 1099-B, and then it's often too late to make any change of course. So, here are the two situations to know where wash sales can be disastrous. First are IRA wash sales, which always hurt. In our last video about the wash sale rule, I explained that if a loss occurs in your taxable account, and you then replace the position in your non-taxable IRA within the 61-day window, the IRS considers this a wash sale. However, unlike a typical wash sale, the IRA wash sale does not involve a cost basis adjustment. That means you cannot take the loss in your taxable account, but you also cannot adjust the cost basis of the replacement in your IRA account. The loss is permanently disallowed. It's as if the loss never happened. And this can really hurt your taxable bottom line. Often I've seen this happen unintentionally. The trader didn't purposely try to create a wash sale in their IRA. Consider the example of Marty. He's a very successful trader who made nearly $2.9 million in a realized profit in his taxable account. However, he was also trading the same securities very actively in his IRA, oblivious to the wash sale rule. As a result, he had $900,000 in losses permanently disallowed from his taxable account because of IRA wash sales, increasing his taxable capital gains to $3.8 million, and he can't recoup those losses later. Of course, you might wonder, how would the IRS ever know since IRA trades aren't reported on a 1099? And that's a valid question. But the fact is, the IRS regulations require taxpayers to make these adjustments to the taxable trades you do report. And if you ever were audited, they may require you to provide all of your account information, including for your IRA. This is why many traders are using TradeLog. It allows them to track all trade history for taxable and non-taxable accounts. Not only does TradeLog make IRS compliant wash sale adjustments, but it also includes a tool to help avoid IRA wash sales if you do trade the same security in both types of accounts. More on that in our next video. Now, the second situation to look out for is of higher risk for more traders. Wash sale deferrals at year end can increase tax liability, resulting in a higher taxable gain or even putting you upside down. And that's what happened to Vanessa, who we mentioned earlier. How is it? Vanessa had a taxable gain of $166,000 when she actually realized losses totaling $66,000. Well, unbeknownst to her, Vanessa had wash sale deferrals that had snowballed, accumulating as she continued to sell at a loss and replace the same securities throughout the year. By year end, there was a total of $232,000 in losses deferred to the next tax year because of wash sales. These are losses she can't take because they're either attached to positions still held open or that were acquired in January of the next year. We call this upside down because she's having to pay taxes even though she lost money, and that's not cool. Even traders who have a net profit for the year may find wash sale deferrals inflate the taxable gain, making them pay more in taxes. Granted, in this situation, the deferred losses will eventually be realized when the positions are closed out in the future. But who wants to pay taxes on money they didn't make? Let's review what we've learned. There are two main situations where traders need to watch wash sales closely. Number one, trading the same securities in your taxable and non-taxable account can permanently disallow taxable losses involved in IRA wash sales. Number two, wash sales resulting in loss deferrals to the next tax year can increase your tax liability for the prior year. Most important, the more profitable you're trading, the less impacts wash sales will have. I stress that because at this point, you may be getting really worried about wash sales. I find some traders, once they learn about wash sales, become obsessed with them, worrying excessively about avoiding any wash sale, to the point they get distracted from what's most important, making profitable trades. So now that you understand how wash sales can impact you, focus most of your efforts on making more winning trades. The good news is you can take control of wash sales. In both the situations I described, traders can take steps to mitigate the negative consequences. And rather than worrying all year, typically December and January are the months when you need to really give attention to how wash sales might be impacting your taxable bottom line. In our next video, I'll show you how to monitor your wash sales and take control of any harmful situations before it's too late. Did you find this video helpful? If so, please click that thumbs up button to help other traders as well. If you're subscribed to our channel, look for that next video in the coming days. And remember, the education section of tradelog.com contains a wealth of information to help you take control of trader taxes, from wash sales to trader tax status and more. Thanks for joining, and see you next time.